Welcome to the African Allocator Podcast. My name is Chipo Muwowo, and my guest today is Vuyo Ntoi, who's co-managing director at African Infrastructure Investment Managers, or AIIM, which is Africa's largest sustainable infrastructure investor based in South Africa. Vuyo, great to see you and have you on the podcast. Thank you so much for joining me.
Okay, Chipo, good to see you, and thanks for having me.
Yeah, my absolute pleasure. I love asking my guests a bit of a personal question to kick things off. What got you into investing? Tell me a bit more about just your journey to this point.
Let's see. I think there's always been an underlying ambition to be in investments. And I think I've repeated this story a number of times. When I was in university, I worked at a bookshop. And one of the early books I took out was, or loaned out was a copy of Barbarians at the Gate, which obviously had all the crazy, what was then, before it was called private equity, but private equity deal making of the 80s. And kind of that inspired me to sort of think about becoming an investor. And literally in my final year of university, I remember writing out 40 letters to various asset management companies and asking if anybody had an internship or an opening position for me. And kind of one of the first companies that came back to me was an asset allocation company called IPAC, which was kind of did a lot of asset allocation, seeking real returns. And because they'd been the first to answer me and I didn't know what my luck was going to be with the others, I took on the role, and it turned out to be the beginnings of my investing career. And that was probably about, close to 30 years ago now.
Did you study economics or business at university? What was your...
I did, thankfully. So I'm an economics and finance major.
Fantastic. Now, just thinking about AIIM, so the firm is, arguably the continent's largest infrastructure investor. Kind of zooming out a bit, I'm curious to hear about your investment philosophy. So, not just the sort of vision, but also how you execute. So what's the vision, and how's that worked out in reality?
Yeah, I mean, obviously the vision is quite broad, but the idea is really to offer our clients kind of a unique and attractive investment outcome while investing in critical and impactful African infrastructure. So it's really been that journey, and obviously as a business, we recalibrate what that means from time to time. But I mean, really our philosophy is around having investment teams that are based in the markets in which they operate, i.e. boots on the ground, team members who are of the jurisdiction we're investing in, understand the dynamics and the various risks in a way that a suitcase banker might not be able to. But also then applying global best practice. So the AIM business, while kind of currently an Old Mutual subsidiary, came out of a joint venture between Old Mutual and Macquarie, which was started way back in 2000. And as part of that process, we really we took on the investment technology of Macquarie and evolved it for the African continent. And I think we now have a kind of bespoke philosophy and process that takes into consideration where we operate and has strong elements of global best practice.
As you speak to various people within Africa and outside, so I'm thinking particularly LPs, what's the sell? Why infrastructure? Why infrastructure in Africa?
Well, it's slightly different, and I'll explain why. So our business is based off two plinths, right? The first is a South African business which manages South African pension funds into largely South African infrastructure, and that's encapsulated by the Ideas Fund, which is a permanent capital vehicle that we established more than 20 years ago. And that vehicle really offers pension fund investors kind of the normal highlights that an infrastructure fund provides from a kind of long-term hold. Remember, it's a permanent capital vehicle. It doesn't have to sell. It offers stable currency returns and has investments in kind of directly in projects in many instances, and those projects deliver cash flows over periods of time. So that's largely kind of an infrastructure as a differentiator from an asset class perspective versus kind of standard listed equities and bonds. The other plinth is our Pan-African infrastructure funds. So we raise dollar-denominated capital to invest in projects across the continent. Those tend to be a bit more growth focused. So I think the nature of the investors in Pan-African infrastructure tend to be growth-oriented investors and also investors seeking to return capital quickly so that they can allocate to other opportunities. So it tends to be the likes of DFIs who want to recycle to other impactful projects and other investors who are seeking growth. So let me put it this way. The Pan-African fund investors who invest dollars and are predominantly from outside Africa are seeking growth on the continent because that's what the continent really offers. And our South African investors who invest in our rand-denominated fund in South Africa are probably looking for the more kind of stable, steady cash flows. But we are an adherent to, we believe in local capital for local projects. Mm-hmm. Obviously, kind of capital markets and savings markets across the continent aren't equal or the same. And some markets have a deep enough pension market to sustain kind of local currency investment into countries' infrastructure, and some don't. So we are really kind of in the business of promoting the development of local capital markets, so that local capital can be used towards local infrastructure. It takes away so many risks. Currency risk is a big risk when investing in infrastructure projects, particularly when you're facing consumers as the end users, and consumers aren't able, in many instances, to switch between different currencies from an exposure perspective. And while local currency infrastructure might be great, the other issue is obviously trying to reduce inflation rates and corresponding interest rates in country to make it worthwhile from an infrastructure investor or an infrastructure debt perspective. I mean, obviously, if you're looking at local interest rates of 20%, projects will find it very difficult to sustain repayments of debt at such pricing, which is why you tend to find kind of currency funding going into projects because of the low international interest rates associated with hard currencies, as well as the ability to kind of lend over the long term. And in some countries, you find that you don't have a capital market which can lend long term to.
Yeah. No, that's really helpful. Last year, you reached financial close on your fourth fund of nearly $1 billion. Now, I'm kind of curious to hear, how you intend on allocating that capital over the coming years. So I guess there's a two-part question. How do you go about sourcing deals? And give me a sense of the kind of sectors that you're looking to deploy this capital within, sort of which sectors within infrastructure, obviously. Are you looking at?
Yeah, so the fund is A4, and I think the fund from a commitment and co-investment commitment perspective raised $950 million, which we're very proud of. You're correct. It's the fourth of our Pan-African dollar-denominated funds. So, and kind of it sits alongside our other Rand-denominated fund that I mentioned earlier. We have been quite successful at deploying the fund. So, as things stand, I think we're more than 60% allocated already. I think we've had the benefit of kind of between our funds, corralling new deals towards financial close, and we were able to close deals that have been in gestation for a while, quite soon after final close for the fund. So we're already over 60% allocated within the fund, and the fundraising has been quite focused in terms of the themes we're investing against. I think we've identified three macro themes that are driving infrastructure on the continent, and in fact, it's a big theme internationally as well. But we've identified the theme of increasing digitalization. So digitalization on the continent has been growing at a compound annual rate of 40% per annum, data usage. And with data usage growing at such levels, it means that demand for the infrastructure associated with that, it includes fiber, it includes data centers, etc., is growing at a similar pace, right? So, and that's completely delinked from GDP growth, right? So, in a kind of stagnant or slow GDP growth environment, you're still seeing these high digitalization rates, and that's really the theme: is being able to invest in that delink somewhat from GDP growth, and so digital infrastructure is one leg of our investment philosophy. The second is the energy transition. Again, similar to digitalization, where Africa in many ways is playing catch up. A similar theme can be seen in the energy space, where I think the often used number is about 600 million Africans don't have access to clean and reliable energy. And we've been pursuing investments in kind of the energy transition or green energy space, and we made a number of investments in South Africa and around the continent in energy transition themes. Maybe a key element of how we've approached this is that outside of certain markets, we believe that the sustainable way of making energy investments is almost on a B2B basis rather than B2G. What we've seen historically is that, and this is notwithstanding years of promised reform, a lot of utilities across the continent don't charge cost-reflective tariffs, and so kind of generally tend to be without government subsidy or kind of budget subventions, tend to be insolvent, essentially. As a result, PPAs signed with these utilities run into problems. So our approach has been a very kind of commercial and industrial one. So we seek to enter into energy deals with commercial and industrial clients. This is not in all markets. I mean, there are markets where we still believe that the sustainability and reliability from a utility perspective, but on an increasing basis, commercial and industrial power investments are the way to go. The third and final macro theme that we're seeing and investing against is the increase of urbanization, i.e., people moving to cities, etc. The rate at which Africans are moving into our large cities continues to increase. And we believe that these populations will require services. So those services include transportation, they include logistics, they include elements of food security, etc. So across those themes, we've invested in kind of ports, logistics businesses, the cold chain, and some road investments as well. So these are the macro themes that we're investing the fund against, and the basis upon which we've been able to allocate the proportion of the fund that we've been able to today.
What's your typical investment approach then? Do you seek whole ownership of some of these assets? I imagine it will vary if you're talking about a port versus, a wind farm, for example. Or do you tend to take stakes? What's the approach, and kind of what informs that?
The approach is driven by exit. So if in many instances the intention is to build up platforms from an early stage, get them to maturity and to a scale where strategics in the space are then interested in taking them on. So from that perspective, strategics prefer controlling interests in the infrastructure that they're investing in. So our approach is to seek control or co-control positions with agreed upon exit parameters if required. Yeah, so we believe that the way we can exert or influence the outcomes is through having sizable stakes in the businesses we in.
Yeah, no, that makes sense. When comparing the African infrastructure landscape to Western or other markets, what are some key nuances that investors need to bear in mind? What's unique basically about the African infrastructure space? Maybe there isn't anything. Maybe they're just exactly the same. I don't know, but yeah.
Well, I think the underlying philosophy and drivers are the same. Infrastructure is it's critical. It's high capex. It fits within the communities that use it. So there's a significant social aspect to that infrastructure being in place. However, from an investment perspective, on the continent, we tend to be, and I mentioned the energy and digital spaces, is we tend to be working from a place of deficit.
Yeah.
And so as a result, the infrastructure tends to be greenfield. So there's a requirement to build infrastructure from scratch, so develop projects, drive them to financial close, and kind of shepherd them through the beginnings of operations and ramp up. Whereas obviously, I think internationally, the tendency tends to be largely secondary exchange in already existing infrastructure platforms. There is a bit of a mix now developing on the continent. We've seen a number of secondary deals happening, but I think the infrastructure space in Africa is still one that involves construction of projects from a greenfield perspective. But that being said, within the projects that we undertake, is we seek world-class contractors and EPCs. We use the same equipment and the same construction philosophy used in more developed parts of the world. We have a strong sustainability practice that ensures project acceptability and built to exacting environmental standards, typically beyond local standards as well. So there's a greenfield element, but it's no riskier than greenfields elsewhere in the world.
What's your approach to sort of short-term market noise versus long-term conviction, strategy? This is a very long-term investment that you're involved in. I'm curious to hear how those two sort of lenses sit together, because in the short term, there's a lot going on, maybe politically in a particular country. You do want to pay attention to that, but not get distracted. So how do those two things sit together for you?
I mean, I think we're obviously kind of long-term players, but you can't exclude the impact of short-term impacts, particularly if you're investing in a project where your underlying investment philosophy is premised on an exit at some point. So literally, you could be suffering what you call a short-term or medium-term stress in a period during which you have to exit. So to that extent, I think kind of we look out for signs of stress kind of well ahead of time, but kind of from a long-term perspective to ensure that our likely exits will happen in a clear market with in a market or kind of an environment with kind of general stability. Of course, there are those short-term moves or influences that you can't predict, and obviously we have to manage through those. And those are the there's those like currency, etc. And you to the extent there's a hedging market available to offset that potential risk, you take advantage of it. But sometimes there's risks that you don't foresee. So our current tariff uncertainty is, for instance, one of those risks where it's pretty difficult to forecast. But obviously, through your investment philosophy, you ensure that you invest in corridors where there's diversification, etc., to make sure that the impact of a change in one import-export dynamic does not crash the entire business. So again, it's kind of good investment management, diversification, ensuring that your risks aren't overly concentrated. Furthermore, our view is to invest in platforms rather than single project businesses. And again, that drives the diversification from a risk perspective. You might find that in a ports business, for instance, that owns multiple corridors, one corridor could be under stress for one or other reason, but at least you've got the other corridors to make up for the impact of said troubles. So yeah, that's really the philosophy, is one of diversification, both from a jurisdictional perspective. We limit the amounts of single country exposure within the fund. We try diversify across sectors as well, diversify across counterparties between kind of governments with government exposure and projects with consumer exposure and projects with commercial and industrial business exposure.
Outside of South Africa, what other countries are important to the fund?
Obviously, there's kind of the larger funds and the larger countries on the continent. There's the likes of Morocco, which is a large, relatively stable country on the continent. There are a number of large francophone economies, the likes of Senegal and Ivory Coast. There's obviously South Africa in the south, and in the east you have the likes of Kenya. Then there's kind of other countries which are economic giants on the continent, but have in recent years been suffering from the macro shocks that you spoke about earlier, the likes of Nigeria and Ghana. Other kind of jurisdictions such as Ethiopia, which from a population perspective are quite large, and to the extent there's compelling investment opportunities, one really has to have a look. And similarly, Egypt. So, there's the large countries which obviously offer the opportunity of projects that can scale significantly. And then kind of a second tier of countries that have that form parts of kind of global value chains, the likes of Mozambique, for instance, where there's a few developments underway from an import-export perspective that make investment in that market compelling. So yeah, we're not. We do take a macro view. Obviously, it's important to look at what countries are going through at any point in time. But we see ourselves as largely bottom up. So what's the opportunity? What are the risks pertinent to the specific opportunity? Does it make sense from a geographic diversification perspective for the fund? Is it the right sector, etc.? So a combination of top down and bottom down sort of gets us to the right sort of allocation decision.
I've just got a couple more questions. You're co-managing director with Solar Lawson. Why that structure, and how does that work in reality? I'm curious.
Okay, maybe to start with, Shola and I replaced a single individual who was the CEO of the AIM business, and I think when he left, he told us that what he'd found was that he became a baby kisser. Which meant he was doing all the pageantry and kind of managing crises, and felt he was quite far away from the investments.
Sure.
So the decision between Shola and myself was, look, first of all, a problem shared is a problem halved, right?
Yeah.
And also, it allowed, because we share the burden, it allows us to still have kind of a firm footing in investments as well, right? So be particularly active in the investment teams and help the investment teams with their calls and in discussions with counterparties, etc. So that's been the basis. And also, the business lends itself to a nice split from a responsibility perspective. So we've got two businesses with a third to come, where there's almost equal from a scale perspective. The South African Permanent Capital Vehicle, which I take primary responsibility for, and then the series of Pan-African dollar-denominated funds, which Shola is primarily responsible for. So, jointly we're overall responsible for the business, but we've got kind of a delineation from a primary responsibility perspective, which makes it very neat.
Sure. Yeah. No, fantastic. Over the next, let's say, 1 to 3 years, as you look at the African infrastructure landscape, what are some reasons for optimism and perhaps reasons for caution as well from your perspective?
Obviously, the global environment, Africa's infrastructure and economy is very mercantile, right? So lots of trade is, the economies are built on trade. So with the tariff fluctuations currently underway, it'd be critical to understand what the trajectory for goods imports and export is, goods, minerals, etc., and the impact on kind of logistics chains on the continent. I think there's kind of lots of reform in the energy space in across the continent, and one will be looking to see what the impact and trajectory of these reforms is in terms of kind of encouraging increased private sector participation. Furthermore, I think, in essence, it's kind of the macro, right? What's the interest rate trajectory? Obviously, kind of interest rates are a big driver of valuation and the ability to finance projects in many parts of the continent. So that will be a big determinant of just how many projects are closing in the near future. I think that delineation between commercial and industrial and government projects will also depend in large part on what the fiscal position of many African countries becomes. I remember just 10 years ago, during the years of the Africa Rising narrative, governments were relatively cash flush, relatively low debt, and could undertake projects and provide the necessary supports for PPPs, etc. There's a bit of stress at the moment, and the trajectory of kind of those government balance sheets will be telling from an infrastructure perspective as well. But yeah, I mean, I think there's lots of look. Africa is a continent where we operate out of deficit, so there's a big infrastructure deficit. So notwithstanding what's happening in the economy, there's always an opportunity to increase the infrastructure stock and displace inefficient or expensive sources of energy supply, for instance, create more connectivity, and there's demand for these services. So I believe that the growth trajectory for infrastructure projects and demand on the continent remains as compelling as it's ever been.
That's a great place to stop. Vuyo, thank you so much for joining me on the podcast today. Really appreciate you sharing your thoughts. Thank you.
Okay. No, thanks, Chipo. Great chatting.
Thank you.